Hello and welcome to Retirement Today. My name is Jenna Cairns, founder and financial advisor at Beacon Wealth Advisory. And we're here to help get you to and through retirement with financial peace of mind. If you'd like to listen to this podcast or any of our past podcasts, you can go out to Apple Podcasts, Spotify, and Amazon Music. We also have a YouTube channel, which is much better to go to because then you can view this episode, and we have other past episodes out there on YouTube. You just type in Beacon Wealth Advisory in the search engine, and then you can hit subscribe, and you'll be notified every time we have a new video out. And if you have questions on anything we talk about today, we'd love for you to give us a call at 1-800-994-8993. Again, that's 1-800-994-8993, and we'd be happy to schedule a complimentary consultation to get those questions answered. Before we get started, I want to bring on my wonderful co-host, Jacqueline Gladhill. Hey, Jacqueline, how's it going today?
I am super good. And Jenna, we're
Good.
matching. We're matching with our blues today.
Right. Same wavelength,
It's it's
right?
not our it's not our TikTok outfits, but it is blue.
Yeah, it is. Yes. Blue is peaceful and calm, which is what we want everyone to feel today, right?
Yes, yes, especially going into this conversation. Jenna,
Yeah.
today we're going to be talking about something that really, when I first heard it, it either sounds brilliant or kind of completely made up. So
Right, right. Well, those are my favorite kind of topics, right?
yeah, well, same. When people hear, like, I may not be able to convert IRA money to a Roth IRA without, paying those taxes. If you use donor based funds, they're either leaning in or immediately suspicious.
Exactly. And they should be, honestly, right? I mean, it almost sounds too good to be true.
Yeah, right? Because it sounds like one of those financial claims where you're like, there is no way that is a full story.
Exactly. Yep. So let's start there. It's not magic, it's not a loophole, and it's definitely not a way to make a Roth conversion just somehow not taxable. But there's a lot of wisdom in this strategy by combining the Roth conversion and also the donor based funds, which we'll talk about.
Yeah, it sounds really important.
Very important because long term, we want to give Uncle Sam as little as possible, right? And save
Mhm.
our money for our families.
Yes, yes, absolutely. So, what are we going to be really talking about?
Yeah, well, it's like I said, basically a tax planning strategy where someone who's already charitably inclined may be able to offset some or sometimes much of the tax impact of a Roth conversion by making a charitable contribution, often through a donor advised fund. And some people, Jacqueline, don't really know what a donor based advised fund is. It's basically just a charitable account that you set up, almost like your own personal little foundation that you can set up to make very big charitable donations to.
Okay, so it's less about kind of the secret IRS trick, more about if generosity is already part of your life, then there may be a
Yes.
really smart way to coordinate, into your tax planning strategy.
Yes. Yes. Exactly. You totally got that.
All right, so let's kind of back up and define the pieces here because there are a lot of moving pieces. And I know that people are probably listening right now who are maybe on a walk, maybe driving to work or in the car, folding laundry, half distracted. And they might need to make sure that, make this simple, make this
Yes.
right, bulletproof, simple.
Yes. Yeah. We love a distracted listener, right? We're going to get them to listen, aren't we, Jacqueline?
We do. And traditionally, I'm also one. So,
Yeah. I hear you. We all have a hard time sometimes staying focused, right?
yes.
So first, a traditional IRA is generally funded with pre-tax money. It grows tax deferred, but when you take that money out, it's usually taxed as ordinary income. A Roth IRA works very differently. And you and I love Roth IRAs, don't we,
Mhm.
Jacqueline? You
Yes.
fund it with after tax money, and if the rules are met, it grows tax free and it comes out tax free later. What do we like better, a taxable investment or a tax free investment?
Tax free.
Tax free. Thank you. A Roth conversion is when you move money from a traditional IRA, which is pre-tax, it hasn't been taxed yet, and you pay the taxes on it and move it into a Roth IRA. So the amount you convert is typically treated, though, as taxable income in that year.
That's important. So if I
Yep.
convert, I mean, let's just say $100,000, the IRS is basically saying, "Great, we're counting that."
Yes, that is going to count as income on your taxes. Exactly. And they are very aware of that when we talk about that strategy.
Always. Okay, so let's define the other half here. What is the donor-based funds that you're talking about, Jenna?
Yeah, well, usually when people say donor-based funds, what they're really thinking is donor advised funds or DAF. And a donor
Mm,
advised fund is basically, like I said, just a charitable giving account. Think of it as almost your own personal foundation. You contribute money or assets into the account. The gift is generally irrevocable, so you can't change your mind once you put it in. You may get a charitable deduction in the year of the contribution, and then you can recommend grants from the account to charities over time. You just have a lot of control over that account. You
mhm.
can, give it to the charity all right away, or you can give it to them over time. So it's just very flexible from that standpoint.
Yes. So, as my job here, I'm supposed to put this in plain English for our listeners.
Yes,
So,
yes.
it lets you make the gift now for tax purposes while you can give the money out to charities later on your own timeline.
Yes, like I said, you just have a lot of control over when you disperse those charitable contributions. So people like that. They like that control,
Mhm.
right?
Yeah, but I think the control also comes with a lot of confusion, right? I mean,
True.
people hear the donor advised fund and then they think that it's some kind of investment account with maybe special tax powers.
Right. And it's better to think of it, like I said, as more of a charitable tool. The tax
Mhm.
benefit comes from the charitable contribution, not from some mystery IRS feature that nobody knows about, right?
Yeah, great point. So let's address kind of the phrase that it seems to get everyone's attention is convert to a Roth without paying taxes. Because I mean
Yes.
that phrase is doing a lot, saying a lot there.
Oh, yeah. Yes, it really is. And that's how a lot of the marketing goes around this strategy, which, it's not really the accurate version, in my opinion. The
Mhm.
accurate version is the Roth conversion itself is still taxable. So people need to know that. That
Mhm.
part doesn't go away. But what can happen is if you make a large enough charitable gift in the same year to your donor advised fund, you get the charitable deduction, which may offset some or all of the taxable income created by the Roth conversion. So if in that
Mm.
year you do $100,000 Roth conversion, but then you also go and you donate 100,000 into your donor advised fund, it can really, like I said, offset that tax quite a bit.
Mhm.
Only on the federal level, not the state level, and it is for people that itemize their taxes. So it's important to know that.
Yeah. Yeah, so it sounds like maybe a much less attractive headline, but a very more honest one.
Yes, and honesty is better, especially when we're talking about the IRS. I think it's a great strategy, but you have to watch the way it's marketed out there, right?
Mhm. Yes. So Jenna, I mean, you always tell stories and I just want to get a story in here and, from a real
Yes.
person and an example of this. I feel like this clicks when you
Yes.
put it into the middle of someone's actual life and maybe how it
Yes.
can relate to our listeners and viewers.
Yes. Well, think about a couple in their early 60s. They've saved carefully for years. They've done all the responsible adulting. They built up a pretty healthy traditional IRA, which again has not been taxed yet. And maybe they even have some appreciated stock in like a joint account or a trust
Mhm.
account, just an after tax brokerage account. Now we're getting closer to retirement, and there's all these questions coming out at once. Should they do a Roth conversion? What happens when required minimum distributions start later? Do we want more tax free money in our portfolio? What are we leaving to the kids, and how much tax are we setting ourselves up for? And in the middle of it all, maybe there are also people that are pretty charitably inclined. Maybe they love their church. They're very passionate about a scholarship fund, a hospital, a food bank, something, and they just want their money to mean something to people,
Yeah,
you
and,
know?
that's a great point, Jenna. I mean, it feels very real to me, but nobody's ever just gonna make one isolated, financial decision either.
Yeah, and real planning is never like today we're only going to discuss line 14 of your tax return. It's really all connected. So
Mhm,
maybe this couple is going to, instead of giving to their church over 5 years to help pay the building fund off, maybe they just give it all in 1 year to their
mm,
donor advised fund. And in the same year, maybe they convert a chunk of their IRA to a Roth to kind of offset that. And so that's really a long term, clever tax planning strategy, um, because it does help ease that painful tax bill, at least in the short term. And so, again, you've
mhm,
got more of your money long term that's going to be reduced in taxes the more we can get it into the Roth, right?
mhm. Yeah, great point, and I like the sounds of that. So the strategy is really about the alignment of this.
Yes, that is the word. It's kind of like going to the chiropractor, right? We're
Mhm,
aligning everything together, a tax move, a retirement move, and a charitable move into the same year, kind of combining those instead of
mhm.
treating them like unrelated decisions because they can really work together to help people.
Yeah, and alignment, and I think another great word is timing, right? And talking about the
Yes.
timing of this is really important.
Yes, it
Um,
is.
and I think what's also interesting here, to me at least, is that it doesn't really just land as a tax strategy for people. This whole conversation, it can feel surprisingly emotional, especially when we're talking about donations and charitable giving.
Mhm. Very much so. It's a really deeply personal strategy because once money gets to a certain point in people's lives, the question often becomes less about accumulation and more about meaning. How can your money make a difference in the world and how can it leave a legacy? And I remember a client changing details, of course, who said something like, I've spent decades building this. I don't want the next chapter to just be about minimizing taxes. I want it to feel very intentional. And that's
Mhm,
really the heart of this strategy. So, yes, we're talking about deductions and conversions and account types, but underneath all of that, we're really talking about people that are asking themselves, how do I make this money serve my future
mhm,
and my family? How do I really make it reflect what I care about? And how do I avoid creating an unnecessary tax friction for my family down the road, but while also doing something good, leaving a legacy. And Jacqueline, sometimes people leave their legacy while they're alive. It doesn't always
mhm.
have to be, when you've passed away. Sometimes it really even feels better when you can see your money making a difference in people's lives while you
Mhm.
are alive, right?
Yeah, yeah, and that's such a
So
different. I mean, I love talking about kind of the emotional standpoint of this because I think a lot of times it's just better than here's a clever move or here's the smart move
yeah.
or the thing to do, right?
Yes, 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 absolutely. And I think a lot of times, like we've talked about, money is so tied to the heart. And sometimes even, people really, some of their identity even is tied
Mhm,
into their money. So it just makes such a big difference.
mhm.
So, yeah. And, another thing that people do, would you say the market's been doing pretty good this year, Jacqueline?
Yeah. Yeah, overall, yeah.
Yeah, and so, you think about these people that have these after tax accounts, like I talked about, like the joint account, the trust
Mhm,
account, it's not in an IRA, just kind of a after tax brokerage account. They've probably got some pretty appreciated stock, right? So if
mhm,
they went and sold that, there'd be probably a pretty big capital gains tax, right?
mhm,
So what some people are doing is taking some appreciated stock or ETFs, mutual funds, and if they've held them for more than a year, if they donate it directly to that donor advised fund, that charitable account, it can be especially powerful. Because if you donate appreciated stock directly and you keep them in the exact same securities, you don't sell
mhm,
them or anything before you move it to the donor advised fund, you can take a charitable deduction for the fair market value, subject to adjusted gross income limits. and avoid paying capital gains tax on that appreciation. So you basically transfer over that stock, keep it in the exact same investments, move it to the donor advised fund. You can then sell it there if you want, avoid capital gains tax, and then
Mhm.
just take some cash and buy the exact same investments in your brokerage account. And now you've moved your cost basis way up on that account. So if you want to go sell it later, you're not going to have as big of a capital gains tax, which is
Mhm.
huge.
That
Isn't that
is
neat?
huge. That is huge. That's such a
Yeah.
great thing to know, especially about
Yes.
timing and alignment of this.
Exactly. I know. And it can help with charitable goals, capital gains concerns, all of that. And this would be a great time to do it because the accounts have grown so much. So,
Mhm.
timing, I have clients doing this right now because the
Mhm.
market's so high and maybe they, want to do something really special for their church or something. And so instead of just taking cash out of their bank account, they take those stocks and those ETFs and mutual funds and just transfer them over into their donor advised fund. And then once it's there, they can sell it whenever they want, let it grow, or give it to the church right away.
Yes.
Isn't that neat?
That is very cool, Jenna. And,
Yep.
I really want to get into kind of some important limits that people should know about this. And, let's do the responsible kind of grown up part. And, I know people are listening and probably thinking, great. But Jenna, what's the catch?
Yeah, just like anything, Jacqueline, I always say there's trade-offs, right?
Mm-hmm.
There are definitely rules to this, especially with the IRS, right? You're going to have rules.
Mm-hmm.
um, First, this only really makes sense for someone if they actually have it in their heart to be charitably inclined. If someone is not actually into any particular charity and they don't really have it in their heart to do that, then forcing this strategy usually doesn't make sense.
Mm-hmm.
Second, the donor advised fund contributions are irrevocable. So once you put it in the donor advised funds, it's not like you can change your mind. They've got to stay in
Mm-hmm.
there. Once the money or stock goes in, it does belong to the charity. Now, you can recommend grants, you can recommend when they take it out all at once or over time, but you cannot take it back for personal use. It's important to
Mm-hmm.
know that.
Yes, that is
Third,
great to know.
yeah, yep. Third, the deduction rules do have limits. So, in general, cash gifts to a donor advised fund are typically deductible up to 60% of adjusted gross income. Gifts of long term appreciated stocks and securities are typically deductible up to 30% of adjusted gross income. And if the deduction is larger than what you can use in 1 year, you may be able to carry the extra forward, actually up to 5 years. Isn't that
Mhm.
neat?
Wow.
Yeah.
That is really cool. So,
Yep.
so this isn't just I give $100,000, therefore I erase $100,000 of tax.
Exactly. That is not how it works. It's also important to remember that a deduction reduces taxable income, not your tax bill dollar for dollar. Does that
Okay.
make sense?
Yeah, and I think that's really important to point out because it's one of those places where people can get tripped up and they really want more bang for their buck, right?
Yeah. Yes, exactly.
So let's
Yep.
touch on, maybe our listeners and viewers are thinking to themselves, I'm still very interested. Would I be a correct fit for this? Who would be the correct fit for this kind of planning, Jenna?
Yeah, like I said earlier, really someone that has a meaningful charitable intent, somebody that has some kind of cause that they really want to make a difference with their money with, somebody that wants to move money from a traditional IRA to a Roth, but they're concerned about the tax bill, somebody that has enough income or enough IRA assets for tax planning to really matter. Somebody that may own appreciated assets in a not IRA, brokerage account, joint account, individual account, trust account, and somebody that's likely to itemize deductions because, again, you can only do this if you itemize your taxes. So, this can be especially relevant in the years before required minimum distributions begin because people often have more flexibility then.
Mhm. Yeah, and who should probably, maybe not force this option?
Yeah. Well, people who need the money for themselves, people who are not truly charitably inclined, people who are taking the standard deduction and won't really benefit from the deduction structure, or people who've heard a simplified version of this and think it's a universal hack. It's not a hack, it is coordination. Again, you can really do a lot of coordination with the Roth conversion strategy, along with contributing to the donor advised fund.
Mm-hmm. Yeah, and I really like that you say, strategy. I think strategy is a key
Yeah.
word here, not loophole, not hack, not,
Yeah.
anything like that.
Yeah.
It's just being smart about your decisions and how they all align together. Um,
Yes.
I do quickly before we kind of close off today's episode, Jenna, what are some maybe common misunderstandings about this?
Yeah, well, one is people think the donor advised funds somehow pay the taxes on the Roth conversion, and it doesn't. We
Mhm.
talked about that earlier. Two, people think they can do this casually at the last second in December. Sometimes the transfers take a couple weeks, and it
Mhm.
takes time. So you want to do it probably earlier in the year and not wait till December. And people third confuse donor advised funds with qualified charitable distributions from an IRA, and those are not the same thing at all.
Mhm.
And four, people think, well, if it's worked for my friend, it should work exactly the same way for me. But everybody's in a different financial situation and probably different brackets, right?
Mhm. Mhm. Yeah, great point.
Yep. Yep.
Uh,
And oh, go ahead.
no, you go ahead, Jenna.
Oh, yeah. Yeah. I mean, that's basically, personal finance. Again, just a great strategy. But, just because your friend does it, it doesn't necessarily mean that it's right for you. Right.
Yes, I'm so glad that you brought that up. That's such an
Yep.
amazing point throughout all of this conversation is that this is not a one size fits all. And it
Yeah.
really is dependent on your personal individual plan and circumstances and, your emotional take on things. I know we touched on emotional and wanting to
Yeah.
give, and maybe that's the lifestyle that you currently live. Maybe it's not. It's so dependent on who what you want to do with your money and the best strategy for it. And
Yes.
sometimes the most effective strategy is also the one that helps people do more than just the one job at once, right?
Yes, yes. That's a great, great way to say that for sure. So really my big takeaway again is if you convert money from a traditional IRA to a Roth IRA, it usually creates taxable income. But if
Mhm.
you're already planning on giving a significant charitable gift, putting that money into that donor advised fund in the same year may create a deduction that helps offset some or all of that tax impact. It
Mhm.
doesn't make the conversion magically tax free, but it can make the net result much more manageable from a tax standpoint. And all of these tax strategies that we're doing is really to help reduce our long term tax bill down the road, not only for
Mhm.
us, because we've got to worry about tax brackets, IRMA, Medicare,
Mhm.
all these, RMDs, things down the road, but also for our family. Some
Mhm.
people just really don't want to leave a huge tax bill to their family when they pass away. So getting more of that into the Roth IRA is just, it's going to help your family have much less of an IRS tax bill down the road.
Mhm.
We would
Yes.
rather give it to our actual family and not Uncle Sam, right?
Yes, I think we can all agree on that one.
Yeah.
And I also just want to remind our listeners and viewers that timing really does matter. And, it matters on your age, the timing of, where your money is at, how long it's been there. There's so many different timing avenues to this.
Yes.
But I think that what you just said, Jenna, and the kind of the key takeaways there, I think that that is a great place to end.
Yep.
Because for the right person, this really can be one of the those rare strategies that connect those taxes, the retirement, and maybe the generosity in a way that feels both smart and meaningful. And
Yes.
Jenna, I know for our listeners and viewers, there's probably a lot of questions out there, and maybe they want to go over their strategy, and maybe a Roth conversion is right for them. How do they
Yes.
connect with you?
Yeah, well, we would love to schedule a complimentary consultation to learn more about your financial goals and see if this tax planning strategy would be a good fit. Also, Jacqueline, I just want to say that we have a whole team now of CPAs behind us that we're
Mm.
able to really go more in depth on tax planning when we're doing retirement planning. And so, this strategy in particular, our CPAs are very savvy with. So, we would love to just get together for that consultation at 1 800 994 8993. You can give us a call to schedule it. Again, it's 1 800 994 8993.
Well, that sounds like the dream team over there to talk
Yeah.
about such, different things, so many variables in retirement planning. But it sounds like a great thing to consider and to talk to your financial advisor about. So thank you,
Yes.
Jenna, for a great episode today. And that does
You're
it for this
welcome.
episode of Retirement Today with our host, Jenna Cairns.